Introductions like this are often unnecessary, but I'll just remind everyone. We have a co-founder of Apollo Management, a co-founder of Harris Blitzer Sports, and recently, and the reason we are interested to talk to you today, or one of the reasons, founder of 26North, a firm with strategies and positions in private equity, in credit, and insurance. And I wanted to start the conversation, given that founder appears in all those experience sets. Your experience as a founder, say in the time when Apollo was founded and the time when 26North was founded, very different industry. You came with a very different experience set, obviously. But what were the big differences? What were the things that were still true then and true now about going to market in a business like this?
Yeah, so a lot in that question, but just to try to unpack it, I would say that, when I started Apollo, it was 1990, and it was really a cottage industry. I mean, you would go to visit U.S. pension funds, endowments, and there would be the fixed income group, and then there'd be the equities group, and then there'd be this office down the hall where people were doing something in private assets. And it was a very small industry, and what's happened obviously is now you have an industry that's multi-trillion. It's become institutionalized, and everyone's focused on alpha and excess return for the investors. And then fast forward, right? Obviously, there's the big 10 firms, right, are garnering half the capital. They're $100+ billion public companies in many cases, literally thousands of people, the new banks, if you will. And I saw it. You don't, for firms that are managing $500 billion or $1 trillion of assets, right? You move from being alpha oriented, being return oriented, to being asset management oriented. You're gathering assets. It's really hard to move the needle if you're $1 trillion of AUM if you don't have a $25 billion strategy, right? And so you've seen this bifurcation in the industry and a change in the industry and institutionalization in the industry, but also really a drift away from what was the core mission of the industry, which was creating better risk-adjusted returns for our partners. And so that's the industry. Personally, I mean, obviously, when you do a startup at age 50, at age 25, you're a doer. You just do everything with a small group of people. We were, we were birthed in the 1990 period where it was, we pioneered something called distress for control, which now obviously is, commonplace and an industry standard, if you will. And now, fast forward, when you do a startup at the age of 55, you go from doing to managing to leading, right? So for me personally, that's been my personal journey where now it's about culture and people and mission and getting a group of people to be on a mission, for returns, for alpha, for our clients where we are blessed to be fiduciaries. And so that's been my evolution, personally. And I'd say, look, obviously when you're 25, you're looking to pay your college debt off and very, very focused on, kind of value creation. And as you, get to be older, doing a startup at 55, you're clearly, you have capital and other things that you can, and relationships that you can bring to bear that you didn't have an experience, right? And one of the reasons why I started 26North was I felt I had a really unique position in the industry to do something that had never been done before, which was start a small, a mid-sized firm with big firm capabilities. And, in alternatives, right, you have to, you have to fund a big overhead structure before you get, paid. So I was able to do that, but stop there. Lot in that question. Could probably go on and on about it.
Yeah, well, actually, it occurs to me as you're talking, do you think it's even possible at this period in the industry's maturation for a couple of 25-year-olds to go out and launch something and have an opportunity anywhere near the one that existed in 1990?
Yeah, I think today we're living in the bar's gone up, and I think that today there is, the lack of capital in the industry. Clearly there's an overhang, and we as an industry haven't done a very good job of basically giving returning capital, right? You saw DPI up there, right up there with returns. I was looking at the numbers. You have to go back to vintage 2016 to get a 0.9 or a 1 10 years ago. That's like a good, you're doing a good job relative to the industry. That's ridiculous. I mean, I remember when, we were, so that overhang, right? It makes it harder to raise capital, but I think that certainly for specialist firms, you can hoist yourself up, but you're gonna have to start a lot smaller and be a lot scrappier probably.
Interactions with LPs now versus then. Have the question sets changed? Have the interactions changed meaningfully, or is it still the basic set of concerns and questions?
I would say that by and large, again, there's been an institutionalization of the business, and what we've gotten away from is, so there's, whole, I'd say the LPs have now huge staffs of people in many cases that have done this for many, many years, and they have a series of questions that they go through. And so, whereas, when the industry started, right, it really came down to bets on people, bets on, okay, I trust you, right? And what I often say to our partners, and we're a very different firm, right? So we're going back to basics and going back to how we used to do business. We obviously need documentation. We need to fill out all these questionnaires, but at the end of the day, if we can get to the point where you trust us to do what we're saying to you, then we can we can do really good things together. And the documents themselves never really come into play because there's that element of trust that we're all working together. And in our case, 80% of our investors are multiple strategies. So like we start with one strategy, and we've been able to, even in our short life, do what we said we were going to do, and outperform in terms of value creation and alpha and risk-adjusted returns. And then also, our personal dialogue with the investors. So for me, this is a personal, I feel lucky, and I say to our team, which is now 160 plus, that we're all lucky to be in this room. And what does it mean to be a fiduciary? It means that the investor capital is more important than our capital and our personal successes. And so we're on this mission. And so once we, it's about risk-adjusted returns, but it's also about how you treat people and transparency and being very investor-friendly every step of the way. And so that seems to resonate right now in this age where clearly institutionalization is important, right? You're investing billions and billions of capital on behalf of big systems, but on the other hand, these are really bets on people. No matter how much it says in the the data room, you're really betting on a group of people, particularly in something like private equity, where you give someone capital for many, many years. You're betting that they're going to do what they say they're going to do. And so I think we've gotten a little away from that, and I think we need to come back to it a little bit. And I think that's how we structure our dialogues.
Time horizons and risk-adjusted returns and all that conversation, those conversation elements in the context of institutional investors. There's a lot of talk now about whether or where retail fits in the investor base for the asset class. You've expressed a point of view on this, and I think for those of you who may not know it, better to start with you expressing your point of view, and then we'll drill a little deeper.
Look, I mean, what I said before, and I'll say again, is that I've seen this before, and if you think about the industry, it started with the endowment system in the U.S. and went to the U.S. pension system. It then globalized, and capital was plentiful, right? And there was more demand for the risk-adjusted returns in private assets, and private equity and private credit were better. And so there was a chase around the world to deploy capital, and so people lost their discipline. And it's the old Warren Buffett saying, when the tide goes out, and then interest rates went down, 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 and then ultimately they went up, right? And so when the tide goes out, you notice who's swimming without a bathing suit. A lot of people were buying $1 of cash flow and then revaluing it and selling it, not adding a lot of value, right? So that was the situation that we found ourselves in. And so, retail now, the institutional market's seized up because we haven't given back enough capital. And so the next big growth area is retail. It's the last thing that's left. If you look at the average retail investor, they've only invested 2-3% of their assets. And so ultimately, everyone is designing products and things like that to, in essence, appeal to ordinary people so they can invest in alts. And so I think the problem is that, so this has happened before and it doesn't end well. The reason it doesn't end well is that the retail investors don't always understand, and we haven't done a good job as an industry explaining that the liquidity of these products, these are long-term assets with short-term liabilities, and if you need the capital to live on or to pay for college, you can't necessarily get it out when you need it. And so that and also I think people misunderstand the duration of the products. And so for both of those reasons, I think that you'll see cases, and you're seeing some of it today in private credit, where people want their money back and they can't get it, and they end up getting, in essence, selling at big discounts to get their money back exactly when they need it. And so I'm worried and concerned that we're going to go through this cycle again with retail investors, and it will cause a backlash against the industry. And I think, as everyone in the industry also knows, right, the retail products generally have to be deployed right away, and therefore they put a lot of pressure on returns. And they probably get certain GPs to do things they wouldn't otherwise do because they have a lot of capital and they need to deploy it, versus the way many of us have structured our relationships, which is commitment-based funds where you get paid as you commit the capital. So for all those reasons, I'm a little worried, and you're seeing some of it today, but we'll see what happens.
Is there a path where there's an alignment potential if you know that the retail investor is thinking long-term? I'm thinking here about retirement as opposed to the discretionary or what they may think of as a transactional account. Or is the compliance and the regulation and the burden of that just an inherent mismatch?
Look, my sort of view on this is that there's accredited investors that have a certain amount of net worth and a certain amount of sophistication, and there's unaccredited investors that need the money to live on. And for unaccredited investors, there are pension funds, there are insurance companies, there are vehicles, right, that are set up for them to invest in alternatives, and that may be the best way for them to invest in alternatives because they understand liquidity, they understand downside. There's a lot of regulation. For accredited wealthy investors, clearly there's a place in their portfolios for private investment, private assets. But when you just mix it all together and you go out with like 40 Act companies and other things that may not be regulated in the same way, I think it's just a recipe for kind of problems at the wrong time for the public.
Thanks for that. Let's shift the lens to the investment strategies and thesis behind 26 North.
Let's go.
We'll begin with the private equity side. Sectors, where is the sweet spot for 26 North when you're looking out there?
Yeah, so I mean, obviously what we try to do is what I've tried to do is hire amazing people and then create alignment with investors. So 26 North is a firm by investors for investors. So I pay the same fee as everyone else. I'm amongst the largest, if not the largest, investor in all the platforms. And the people that work with me, they also take cash hits and are very aligned in terms of their own economics around alpha, around returns. And so I start with, like, you win with the best people and the best culture. Having said that, this is a good vintage year, and we've we've decided that the upper middle market between the big firms and the massive amount of small middle market firms, so $1 to $5 billion TVs, our check sizes are 150 to up to 700 million. A lot of co-invest in cases that are big, and so and then kind of having a big opportunistic lens where you have go and trying to trade complexity and aggravation for rate of return and purchase price for value. So we're all about buying cash flow cheaply and going back to the basics of what private equity really was when at least I started in it. And if you buy mid-teens cash flow yield in good businesses, you end up that's going to take you generally, you cure a lot of sins. If you pay low multiples for good businesses that generate mid-teens cash flow, you have a lot of downside protection and you have a lot of upside optionality, and that's how we're operating our business. And so we're taking advantage of two big trends. One is that the public markets just don't care anymore about mid-sized companies. One of the things that I think is going to become apparent is, even for some of the larger firms, that the ability to exit in the public markets is going to be very difficult. And so ultimately, unless you're one of the NVIDIA or some of the top 10 tech stocks, which are now 40% of the S&P and more than half the returns, the bottom 200 stocks in the S&P are like 6% of the index in terms of market value. And then you have thousands of companies below that. So the companies, the 500 million EBITDA, 700 million EBITDA companies that people are buying, who's going to buy those? It's going to end up being, people are going to trade back and forth. And so as the investor capital seizes up, that the ability to exit is going to be dependent on cash flow and debt markets, right, and private equity markets. So when you're buying, and so we're the beneficiary of the fact that the public markets don't really care anymore about companies that are not significantly growing and big size or really fast growing. And the second big trend is just the fact that the middle market is decimated. So about half the capital, depending on the year, in alts is going to the top 10 firms, and so the middle market is really, for the most part, really struggling. And about more than half the deals we're doing are middle market private equity firms that either need to sell to raise another fund to generate the DPI that we're all talking about, or really are out of business, right, and are dying a slow death. And there's a lot of the industry that is like that. That once you do your first continuation fund at a discount, that says a lot to investors. You're sort of then end gaming it. So that's how we're doing it. I could probably go on and on, but I'll stop there.
A word that comes up a lot when talking about some of the businesses you're attracted to, and this is true, I think, in the private equity portfolio, but also on the sports side of it, is adjacent. Media adjacent, sports adjacent activities. What's the characteristic of that kind of investing right now that makes it attractive?
Yeah, so I mean, what we've done is, so first of all, our average multiple is 7 times. So literally, when I started the company, I recruited an incredible private equity team led by Mark Weinberg, who had come from Brookfield, and we hired amazing people, and the first deals were at like the industry average 10, 11 times. I was like, we're not doing those. Veto. Have veto, we'll use. And so after a while, everyone was like, we're never going to put any money to work, and so forth and so on. So, we got through that, and all of a sudden we have put a lot of money to work. We put substantial capital to work in very good deals. But one of our strategies that you're referencing is, sports is a growing business, data centers are a growing business, and we buy and invest in companies that are around those ecosystems that are benefiting those ecosystems. But for example, if you buy a sports team, you're going to pay 100 times EBITDA, right? Like, so far from being a value investor. So what we're trying to do is be involved in businesses that are around that ecosystem, that are growing with that ecosystem, but not necessarily priced where that ecosystem would be priced. We did another deal called Archkey. It was a electrical contracting business, but it's growing like crazy because it does big projects like data centers, and so it's not a data center, so it doesn't trade at a 6 cap. We were able to buy it around our average multiple, and literally its EBITDA has doubled in 2 years, and it just shows you that what you can do if you're willing to kind of do adjacent or derivative investing.
I can see we're running a little short on time, but I don't want to let the conversation go without talking a little bit about what you're doing in private credit.
Sure.
And maybe just talk about the strategy there and how it's manifesting.
Yeah, so everything we do is about alpha and returns, and you got to start with where is there a shortage of capital? I would say we were early in private credit. There was a shortage of capital in the middle market direct lending space, and we started a business that is about $9 billion and is financing 25 to 125 million of EBITDA companies, senior secured unitranche first lien, single B, double B risk, 50% loan to value, and we're generating 200 to 300 basis points over the high yield and leveraged loan market for better risk with covenants. And so that's obviously that space has gotten a little notorious. We'll come back to that.
Yeah, well,
you'll stop there. So.
Because a year or two ago at this event, we were talking about the possibility we were in a golden age of private credit.
Yeah.
And the sentiment has changed just a bit if you look at the headlines.
Just a little. Yeah, look, I think that I think that things are a little overdone right now. Personally, my honest answer would be that, and I'm aware of everything that's in the headlines and going on. We're late stage in a long credit cycle, right? And spreads are thin, particularly in the public markets. They're as thin as they've ever been since I've been around, and that's unfortunately way too long. And so you got time to be careful, right? And so you are seeing a series of bespoke defaults. Not everyone is as careful as everyone else, and whether it's fraud, whether it's Amazon business models, whether it's redemptions, you're seeing some things that are endemic of late stage environments. But I still believe that this is a great asset class. It's really driven by ultimately the banks getting out of major risk areas, right? And we should come to the second part of private credit, which is investment grade. But I still think this is we literally are 3 years in business, no defaults, no losses, 200 to 300 basis points of excess return. And I think that you can, it depends on who you're with, right? It's now become an asset picker, company picker market, right? You can't just buy everything. And so, and I do think that we'll settle through these, you're going to have defaults, right, in any credit business, and we'll get through it.
I'm just going to ask you one quick last one. Goes to sports.
Sports.
You have your
favorite topic.
You have your side gig. You've got your position with the Commanders. It looks like the Seahawks might be on the market.
They are. Could be.
Would that be one of the better returns you've managed in a couple of years if the valuation adjusts to what the Seahawks are asking?
Well, what I would say about sports is that, obviously, so we don't cross. We utilize the adjacent sports ecosystem, but that's really growth investing. I joke, so I bought the Commanders in 2023 for $6 billion, and it was the highest price ever paid on planet Earth for their sports team, and I joked that my value investor credentials were shattered. I paid 100 times EBITDA. But I felt that, the NFL and certainly some of the other leagues that I'm invested in were live entertainment, live content was going like that in terms of consumer interest in spending. the media ecosystem was massively globalizing. And this is also where AI is going to deliver enhanced content and very customized content. You're going to see a big jump in how sports content is delivered. And you're seeing massive jumps in media. And then, the teams themselves were going up in value a lot, and there's a lot of real estate opportunity around the teams. And so I felt that there was real upside. And obviously, now there have been minority stakes at the Giants, at the Patriots, at the, some of which are over $10 billion, minority stakes. And so I do think it's an investable asset class. I think it's very A-correlated. It's a bet on live content. I do think this will continue to go up. And you look at the NFL, if you go back and look at it, $1.3 billion for the Bills in 2013, $2.4 billion for the Panthers in 2018, $4.6 billion for the Broncos 2021, 2022, and then obviously us at $6 billion. And now you're seeing, and so the Seahawks, I believe, will go for a very large price. And you're seeing the leagues begin to welcome in institutional capital. And so I do think that, there is a place for it. It's not value investing. It's not, one of the big institutions that we help, who's a big client, they said to me, we want to get into sports. I said, okay, before you go any further, how do you feel about 100 times EBITDA? Yeah. And they were like, okay, we're not into that. And I'm like, okay, that was the end of the conversation. So you have to this is, in essence, growth venture, growthy type investing. It's not venture, it's growth. These are big leagues. They are fundamentally amazing business models with locked-in media, and the leagues themselves operate and sell their trademarks together, right? So that's a different structure than a lot of us are afforded. And so for all those reasons, I think it's a great investable asset class, and but it's something that I do as a personal matter and not as a professional matter.
Thank you very much for your time. I appreciate it.
Thank you, guys.
Thank you all. Thanks for watching. For information about PEI Group's entire portfolio of events, please visit peievents.com.